You may have heard that apparently we're going to war with China. Now, in the event that Australia takes on China and causes a chain of events which leads to the nuclear holocaust, you could be forgiven for thinking that the only thing which will survive are the cockroaches. Wrong. The only thing which will survive is the Australian property market. The Australian property market is one of the most mollycoddled markets in the world. There's nothing that governments won't do to sustain high property prices. Property prices are already up 8 to 10% this year, which means 20% annually. They sailed through the global credit meltdown in 2007. They sauntered through the GFC. They came off a bit, flatlined for a while, suddenly this surge through the pandemic. If you take the total value of Australia's GDP, the total savings in the superannuation system, the total value, the market value of the Australian share market, the ASX, put them all together, and the property market is still bigger. And it's all down to government settings. So the settings are these: negative gearing. There's capital gains tax relief from many years ago. There's what's not there. There's a failure to introduce money laundering legislation, which was supposed to have come in 12 years ago to stem the flow of black money coming out of countries like China into the Australian property market and other foreign sources as well. And more recently, since the pandemic, we printed about $200 billion worth of new money. That's sitting at the RBA on deposit, earning no interest. It's a buffer, if you like, if there is a catastrophe in the property market. The other key factors are the relaxing of regulations for the banks with their lending. There's cash grants, first home buyer grants. There's a relaxing of supers. You can take money out of super and put it into property, kicking the can down the road, of course, for pensions later on. The biggest factor, though, is record low interest rates. This is a global thing. Now, if it turns, there's going to be problems. Can you imagine if you're paying 4% now, paying 8%? How would you service a loan like that as a first home buyer? And we don't have as much control over this as we think. Inflation is a global phenomenon often, and bank lending to the housing market is driven by bonds. Australian banks raised money from bonds, from selling debt securities into global capital markets. That money, 3-year money, 10-year money, is on lent at a margin with a bit of profit for the banks onto the home buyers. So, if global interest rates go up, money becomes more expensive. Servicing a mortgage becomes more expensive. That's the big swing factor. Now, we're not going to give you financial advice here and say the market is going to crash or it's going to keep rallying or any of this stuff. We'll simply point out the reality of what's going on. We've got the rise in home prices through the roof. We've got the explosion in credit, and this is the big one. There's a frenzy of lending from the banks to home buyers. The other big swing factor in this for the property market is not just interest rates going up, but unemployment. If unemployment rises significantly, if it goes from 5 to 10% in the event of an economic downturn, that will mean a whole lot of people will be stranded, having to pay mortgages with no income. One thing we can be sure of, though, no politician wants this to happen under their watch. If the market did fall significantly, or if rates went up significantly and there was a wave of defaults, just as we've seen all the big corporations be sustained by government handouts under JobKeeper and various other subsidies, the Australian property market will be rescued at all costs. The taxpayers, people that don't even have a home, will be on the hook. Historically, we've seen how devastating a housing market collapse can be. The social consequences are immense. Yet there is no policy to cushion this. Homelessness is on the rise, but there's no social housing policy. All the policies are skewed in favour of those people that own a home. Now, Harry Chamay, reporting on the Australian property market for us, he points out the social consequences of our approach to housing, of the government's housing policies over the years. One, of course, is that the average age of somebody getting their first home has stretched out to 36 years of age. People retiring with debt, the age of 65, that's exploding too. People not being able to pay off their mortgage by the time that they retire. And the kids that borrow from the bank of mum and dad are 3 times more likely to default on their loans. So there are social consequences there. Economically, the overriding thing is leverage. It's the risk of too much debt. And the ratio of debt to disposable income is at record levels, around about 200%, twice the amount of debt as disposable income. So if there is a squeeze, that will trigger a wave of defaults instantaneously. People are over leveraged. They used to own their cars, they now lease them or borrow to buy them. So there's a raft of initiatives for people to do renovations, for people to buy houses, for people to own investment properties. But if you look at those people that can't afford to own a home, can't afford to pay their rent, there's nothing much in the way of policy to address this issue. There will have to be, because as we've mentioned on this channel many times, inequality is on the rise. The pandemic has accelerated that. Government subsidies have predominantly gone into people with money or companies with money. Nothing in the way of social housing, which would actually be quite a constructive thing to do economically, because it will create jobs, it will create new homes, it will provide employment and housing at the same time. Like this video if you'd like to see more constructive government policies which don't just favour the people and the companies that donate to the political parties. Property prices might be on the rise, but the price of our merch is dead flat. Subscribe to help us cover the inevitable fallout of 30 years of policy neglect.